additional.
Actually, just had an exit yesterday. It was announced in Boca. It was bought by Pernod Ricard from France.
Oh, well then.
That's good. And I need to leave to negotiate another exit in this month. So.
Well then, so we need to talk about it.
Yeah.
Perfect. It seems that we are going live. Let's wait another 10 seconds for all the community to come in.
How many people are connecting?
So usually we have 5K views average per episode, but a lot of people see the show after it goes live. And yeah, officially we are live. So welcome to the Scaleup Valley. Welcome to the Scaleup Valley podcast. As we know, we compress key lessons about scaling up companies from 1 million to 100 million US dollars in annual recurring revenue. That's our first show with an investor. So we have been having CEO interviews, also discussing scaling up on a product perspective, on engineering, marketing, sales, customer success, with some of the best tech leaders in the world joining us from San Francisco, New York, Madrid, Barcelona, London, Berlin, Singapore, etc. And we thought it would be very important to also have the investor perspective in the process of scaling up companies. And today with us, we have Gonzalo Tradacete, managing partner at Faraday. And it's really a pleasure to have you as our first guest representing the investment community. So thank you so much.
Thank you very much.
So yeah, let's move forward and get a little bit to get to know more about yourself. And so how did you went becoming or starting up Faraday? So what were you doing before?
Before Faraday, I was at KPMG, mergers and acquisitions, financial sector. Before that, I was in a hedge fund. So I've been quite an investment finance analyst for most of my professional career. But also since a very young age, I was in love with the entrepreneurship spirit, and I started from the age of 13 making my own little businesses or business initiatives. Really, you cannot really constitute a company when you're 13.
Got it.
But you can wash cars and make tortilla de patata. So obviously there was some room there for professionalization and everything. So I chose my profession to try to get the best tools to be able to build my own company with the best guarantees. At the end of the day, my experience was built into the investment finance field, and since I was in love with the entrepreneurial spirit and what kind of value it can bring to society, I decided to put up an investment club in Spain in 2011, which is called Faraday Venture Partners, and which was the most similar figure to a pledge fund by which our members, the investors, can choose the amount they want to invest in each of the opportunities we offer them. But if they invest, we really work for the success of that startup. We're not just in the transaction or like a crowdfunding platform, an M&A advisor, but we transform ourselves into a VC partner to try to help to the success, commercial particular success of the companies that our members invest. So it's a hybrid between a business angel network and a venture capital fund, really. So it's a weird animal that tries to give the flexibility and the knowledge to the investor to be able to interact with the CEOs they invest in and to help them commercially in particular, but who are protected by investment professionals who are on a day-to-day basis following up their investments. So that was the idea of Faraday. At the moment, it's the biggest private investors club in Spain, and we're now opening new clubs in Portugal and Germany this year.
Well done. And the business model is fascinating, and I think it's quite innovative. And being innovative in the VC space is not easy. So congrats and kudos to you for having this vision, and congrats also for expanding already your footprint in Portugal and Germany. And again, I think that your investment thesis is also very innovative. So if you can talk a little bit more about it, what is the investment thesis today of the VC part?
Well, I cannot talk for every VC because what I see in most VCs, actually, I was 2 weeks ago seeing 15 pitches from VCs trying to raise funds for their LPs, from new investors, and 13 out of 15 said they were deep tech, for example. That was their focus and whatever. So it's fine, but we've always had a contrarian approach. Basically, we love what is off circuit. We've invested in circuit companies that are, for example, now using blockchain, but for a particular purpose, not because of the fashionable aspect of the circuit. Yeah? So we try to avoid the hottest sector, and we try to look at every single startup or company from a bottom-up approach. So basically, we see their numbers, their recurrency, their return, their churn, their customers' feedback. We call the clients, in particular if they're B2B. If not, if they're B2C, we do a lot of mystery shopping, for example, for commercial due diligence. But we can invest in absolutely anything that has at least 6 months. That's our filtering criteria. That allows us to invest at least 150,000 euros. We can invest 700, 800,000 in a first ticket, but we are happy to enter at an early stage, early commercial stage. For us, it's very important, since we're not specialists in any sector, that they have some clients and we can talk to them, we can see their commercial numbers. So our approach is totally sector agnostic, very bottom-up approach, and very based on numbers for the filtering part. Obviously, we make meetings with the promoters, the CEO, CTO, etc., and try to check whether they have the right motivations, ambitions, etc. But all this is much more subjective.
Got it. And in terms of some of you were just before we go live, you were sharing good news about some exits that you had. So what were the most successful investments that Faraday has done so far?
I think the most successful in terms of a multiple was Habitissimo, which was our first investment. We sold it in early 2017. It's a bit kind of 5 years, more or less. And we had a 10.7 times multiple, which was very good. But in terms of IRR, we've had higher because we've sometimes exited at twice in less than a year. So the IRR was over 100%. So that was very good as well, even if the multiple was not that high. It was just twice, but in a very little period. And now we're negotiating. Yesterday we had another exit. The multiple for the first enter was 4 times, which was good. It's not as profitable as others, but it was a very nice acquirer and a very nice, very well managed company, according to Scaleup criteria.
Got it.
By Pernod Ricard, who bought the company yesterday, bought the Boca.
Congratulations.
Thank you. And we're now negotiating another exit, and we are quite proud of that one because it's the own founders who are wanting to buy us back and not sell the company, but become a big company. Because you know that in this VC industry, because of regulation and many other factors, we're nearly forced to sell the companies.
Got it.
When we have VC investors, or because they have 8 + 2 years to sell, so in dividend terms, you never get it. But it's difficult when you have to sell the companies in less than 10, 15 years time to build European champions with the American and Asian tech giants. Yeah? So we're very happy when entrepreneurs get strong and say, I don't want to sell my company, I want to buy other companies.
Right, to go for the long run.
We're quite proud of that kind of attitude. Even with that, we're going to be selling it at least 10 times our entry valuation with just one entry. That's a shame, but in less than 3 years, which is very good.
Got it.
It's a even bigger IRR than Habitissimo and the other two times in less than a year.
Got it. And how many investment or portfolio companies have you made so far since the beginning of Faraday?
We've invested in 24 companies, and we're investing in 4 new companies this month of July. Our first Portuguese investment as well, which is very
Congratulations.
nice. We're very excited about
public already?
Sorry?
Is it public?
Not public yet. Probably in a week or so we'll be able to tell it.
Got it. So I'm very curious. No.
And 2 exits in the month, which is very good as well. So 24 plus 4 companies, we've already sold 2, so that's 28 minus 2, 26 minus 4, which went bankrupt. We still have 22 in the portfolio.
Got it. Well done. Yes, Odd, I wanted to ask you also what kind of factors or things that turn you on in investment when you are talking with potential investment opportunities or teams. What turns you on and what turns you off? Is there any kind of criteria like team or total addressable market or the modes? Is there anything in particular that really gets you excited about investment opportunity and something that you say, yeah, I don't want to talk more. I'm not interested. This is not for us.
The only thing that really can tell us not to talk more is the attitude of the person you have in front of you.
Team.
So a very negative attitude or belligerent or stuff, we don't like that. We do this because we really believe in the value we can provide, not only to the companies we invest, but the companies we invest into society as wealth creators, and really believe in that. If it's to be angry at each other at each board meeting and stuff, it's not going to be worth it. And it's probably not going to create a value.
Got it.
So that's the thing that puts us away, the wrong or bad or, really aggressive attitude from the promoters of the company. The things that turns us on, there's many, obviously. And obviously the relationship is with the person or persons in the company. But on a more pragmatic way, for example, for me, I don't know if we call it recurrency, basically clients coming back and buying back again.
Yeah.
So the recurrency of clients, and there's very many different ways of measuring that. For us is the best proxy of the love that the company and the founders of that company try to give to their clients.
Got it.
So we take a look at recurrency in many ways. And we call, as I told you, the clients, or we call our own members and we pay them, if it's a B2C company, the particular lunch or dress or whatever for them to experience the customer experience. And we focus very much in this love the companies we invest provide to their own clients and how do they feel about it. And for us, it's the best proxy of their future commercial success.
Yeah.
Obviously, you get into a lot of metrics, for example, of customer acquisition channel dependency. Even if you give a lot of love, if 80% of your sales come through Google channels, online channels for acquiring customers, well, you have still a strong dependency on a particular channel, and it could be very dangerous for your company. But the most important factor for me, that's a personal thing, is recurrency. Margins are also a very good proxy of the value added you give to your clients. You solve a very big pain for them. They have a higher disposable income to pay you, a bigger share of wallet, because it's an important problem you solve for them. So we love important problems and very happy clients.
Got it. This is amazing, and I love this recurrency as a proxy of customer so or customer successes as well. And usually we in the tech community, we always talk and we always have stories of startups that are kind of trying to conquer or inspire or influence or convince an investor, a very good investor, to invest in them. But we see that really the world-class teams, the world-class companies, the ones that show all the criteria that you are looking for, also can have the opposite. So having investors wanting to really get in and work with that team and work on that opportunity. Do you have any story in your portfolio, in your investments career, where you had this that you could share a little bit, the effort that you need to take, that you need to make in order to be part of the journey of that company?
Each company, it's a world in itself. So, for example, there's companies which we try to help because they don't have any financiers and they don't really know how to calculate their treasury projections, for example, which is a very important thing, because when you do not have a lot of cash, a bad prediction of your treasury could make you go bust. It's not what is going to make you fly. Make you fly is the product, the channels, the commercialization formula, everything. But it's what makes you go bust, because you didn't predict a big pay that you had to make. And so sometimes it's a very limited technical and financial terms help. Sometimes people get divorced, they get angry at each other between co-founders and stuff like that, and it's much more emotional part of our work. But since you've been there and you have an interest in the company and everything, they call you if they believe you're someone who is able to listen to other kind of problems. And sometimes we have to mediate between co-founders. Sometimes it's the contrary. A founder may be very, very happy or overly positive about possible outcomes, and we need to bring him back to earth, because there are dangers that his very positive attitude is not seeing, is avoiding him to see. And therefore what we do is be careful, because if this is not right, plan B is that you don't even have the money to pay the indemnization for firing your workers, and you won't have money to pay them, and you will have be in a big trouble with the authorities, and you could be in jail for that. And many first-time entrepreneurs do not know all these possible legal complications. So sometimes we need to be kind of the bad guy in the board of directors, putting in the table the dangers, their personal dangers, actually. So I think that this emotional regulations, because you're not in the day-to-day of the business, but you understand the business and you have a stake in the business and an interest, can be a lot of help for some companies.
Got it. And coming back a little bit and just giving some context for the listeners who are tuning in for the first time in the show. So there are the Rockefeller habits, which are 10 Rockefeller habits, which were invented by John Rockefeller, one of the most successful businessmen in the history of the United States. And it's all about creating discipline in terms of thinking about the business, executing, ensuring that we have the right people on the right seats, the right pace of execution, as Gonzalo was saying, also the appropriate cash flow in the business to help you grow. And the first Rockefeller habit, it's all about having a healthy and aligned team. And of course, in the scaling up stage of the business, these teams, and just to give you an idea, if we are at 1 million ARR or at 5 million ARR and jumping to 10 million ARR in a year, the headcount is completely different and the challenges of the business are completely different. So, and as a manager, as a leader, you might not be the best fit for the next 4 quarters of the business, and you were the right fit for the previous 2 or 3 or 4 quarters. So things change too fast, and we need always to think about what is the leadership team 1.0, what is the leadership team 2.0, 3.0, 4.0, 5.0, and ahead of time. And some of them will grow to become the 2.0 and the 3.0, and some of them will prefer to just leave the company and join another one to go again from the 1 million to 5 million, or from the 5 million to 10 million, or from the 10 to 20 million. So, and this is usually very difficult because sometimes founders wait 2 or 3 quarters, and then achieving the results or the metrics or the targets become very complicated, and it's impossible to recover the time. I think that's one of the most difficult mindset shifts, and sorry for speaking so long now, is on on the seed stage or even in early Series A, we have a product market fit mindset. And in the scaling up stage, we need that the most precious asset is not anymore the cash that keeps you alive to keep testing new things, but the time to become the category leader. And which means that cash is not so important at that stage. It's much more important time in terms of execution and time to market. So I'm sure that this is one of the issues that you face a lot of the times, and it's very difficult for a founder to recognize that that person that helped them so much in a certain moment of the company, that maybe the company is even going bust, and they have been there, helped to let him know that maybe it's not the right person for the next challenge. So how do you face this? And how do you think about this? Do you agree, by the way, with what I just described?
We try to invest, because we invested in early stage, sometimes with 6-9 months of sales, yeah, in people that have two characteristics, but it's very subjective. First, that are good listeners, that take advice, but obviously it's much easier to appear like someone that is a good listener when you are asking for money than when you already have it and you don't need it anymore. So people sometimes are bad listeners, but very good actors.
Got it. Good point.
I'm not talking about entrepreneurs. I'm talking about investors. I'm talking about people.
People, absolutely.
Yeah? And the second characteristic we care about is, since we know that we try to have good listeners, but we may not have them, I don't know, we will see that forward, is that that are able to manage a 10, 20 or 100 million euro revenue company. That we believe that they will still, maybe not the best, but a very right manager for a much bigger business with 100, 200, 500 employees. Because we know it's their baby. You know, Faraday is my baby. And it's very difficult to leave your baby on its own. And in particular, when someone tells you that you do not have the skills to keep growing your baby, because he's not an adult yet, but you are not the best father anymore. So many people, I think, and I see, let's say, I will learn. I can learn to manage a big business. I've learned to make a business before I didn't make any. So now I'm going to learn, but I'm going to stay. And I'm not one to tell him, you're out.
Got it.
I'm a minority shareholder. So if he is a good listener, which entails being humble, yeah, he will recognize that he may not be the best and put someone inside in his place, or at a chief operating officer level or whatever. But you never can really know it before the time comes. What you try to do as an investor is try to call other investors in other startups he may have had, if he has had some, or if not, ex-employers, to try to see what they think about their attitude and about having people on top of him and stuff like that. So we try to make a couple of checks outside of the conversation we have with the promoting team to see if they actually do have this attitude we believe they have on the conversations. Okay, but as I tell you, sometimes CEOs are very good actors as well.
Got it.
That doesn't mean liars.
Yeah, absolutely.
That
Sometimes
means
they are
actors
about what they are saying.
Yeah.
And I was not only talking about the founders or the CEOs themselves, but I was even talking about having the founders or the CEO building their own leadership teams. I mean, you have a VP of sales, which is quite good at scaling companies from 5 to 10, but clearly has not the playbook and the experience to go from 10 to 20. And even they might not be interested to specialize themselves on going from 10 to 20. They are experts on moving from 5 to 10, and they want to be in the company for 18, 24 months. And that's their role. That's what they are specialized in. That's what they love to do. And they just go from company to company, helping them to accomplish that stage and then passing the job to another senior VP of sales. And that was also the point where I think that's the comments also relate here to what you just said.
I don't think it's really a measure about the revenues of the company, because there are some 10 million euro revenue company a year that have 12, 15 employees, video game industry, for example. So it hasn't changed really. When you had 500,000 euro revenue, it's still the same structure in the business, even if
the headcount.
I think it's more related to the headcount and the inability of some very product-focused CEOs, founders, to manage a growing team and to be able to listen to the little problems or big problems or personal problems or ambitions that. And he's not a man's person. I mean, it doesn't mean that he's a bad person. It means I'm an engineer and I like to be in front of my dad, and I don't like to get inside the skin of another person to try to understand him and to motivate him, and he's not good at that. And before we were 10 people just like me, and we had the same hobbies, and so it was easy. But now we have human resources, we have financial department, we have a business developer, and I don't understand it, people. So if you are able to recognize that, you are able to begin with the solution, which is taking other managers that are better than you at the areas that you need to develop in your company. But I think it's more related to the headcount than to what you like to do as well, what you're able to do well, but what you like to do as well. Because if you get burnt out after taking a company from 0 to 5 million revenue, it takes a lot of energy. And if from that moment onwards, you start doing 80% of the time things that you don't like doing, you may get burned out because you've already put a lot of 6-7 years energy into this company, and now you're doing something you don't like. And I'm still not rich, and I still have pressure from my VCs. I'm still fuck it. Sorry for my French, but so you need to be careful. I think you really need to be careful about the emotions. And emotions is particular of the people, not of the product or of the market. And when you have a lot of people, that means a lot of new emotions coming into the company. So you need to be able to manage that. Are you able to manage that? No, you need to take someone in, some people in.
Got it. Very, very good points about the emotional side, and you gave also some examples of what you need to do in order to support the founders, to kind of help them to see the reality, mediating conflicts within the founding team. It's really a very important topic that very few people talk about openly. And moving forward to the Rockefeller habit number 2, which is kind of assuring that we are focused in the next big thing for the next quarter. This is very related with focus, and there is always, especially in B2B, an example that I gave. The majority of the companies that I know that were very successful start with a very specific vertical and with very specific geos. So they are not trying to cover, even if the TAM is huge and that's what we want, they are not trying to execute in every single vertical, in every single geo at the same time. But sometimes they convince the future with the next step to get closer to the big area audacious goal. So the future, the vision, and with what we need to get done in the next quarter, in the next year, in the next 3 years to get closer to that future. So sometimes it's really thinking, or they think that sometimes it's thinking long term or short term, and we need to kind of take decisions for the short, the mid, and the long term. And this is very difficult and very confusing. So did you have any situations as investor where it was very difficult to help your portfolio or your teams to really take a strategic decision about what vertical to focus on, what she is, and really not avoiding to do too much?
By default, we try to put these kind of decisions in the hat of the founders. I mean,
got it.
We are not industry experts, so we can help a lot with the financial strategy. And once you have the product and a particular commercial strategy, to open the doors that you may need to be able to deploy this commercial strategy and help you with that.
Got it.
But for a new vertical, whatever the founding team says, for us is okay. How can we support you in arriving to that goal that you have decided? We're not going to be deciding for them, that's for sure. For example, we had, I think you know that company, Reclamador.
Sí.
I think it's quite successful company here in Spain.
Changing to Spanish.
It's in our portfolio, and we've been there with them since 2013 as well. So in 2014 or 15, I don't remember, there was a big decision to take, which was at that moment they only were claiming for airlines flight delays and overbooking and stuff. And the big decision was, let's go towards all Europe and compete with the big British and Dutch companies that do exactly this for all Europe in airline claiming, or let's stay in Spain and start claiming not only for airlines, but also for banks, for insurance, for mobile phone companies, and make a brand here in Spain. The second decision was taken, and I had my own opinions, but I tried to shut myself, which sometimes is difficult, because these were just opinions. They were not, based on any empirical data or whatever. And I think if you invest in a founder, you need to believe in their instinct. That's what obviously, if their instinct is at the time of your entry, at least backed by the numbers and everything, yeah. But if there's a change, a pivot to make, I think you should, in most occasions, each company is difficult to make like average or, this is the way you should behave. Each company is a world, I repeat, but we try not to take into strategic decisions apart from the financing and sometimes the commercial channels and commercialization formula, but not the product or not which markets or not. We just try to help opening doors with the right discurso, the right message for clients and for investors, for the companies we invest in.
Got it. Yeah, and our time is, the show is coming to an end. We have almost 5 minutes before you also go to your next appointment. I think that given that you are not very hands-on in your investment style, in the way you support your
we are actually quite hands-on, but only in the areas that we can help.
Got it.
And sometimes with some companies that we invest in do not need our help at all, even in this area, because they are well provided and well.
Got it.
So we are flexible in our hands-on approach.
Got it.
But most is emotional, commercial, and financial.
Got it. Thanks for correcting me. So you tend to not take decisions or impose. Interfere. Got it. That's the right thing to say. And in terms of go a little bit more to B2B SaaS, there is this SaaS napkin blog post from Christoph Jens, which is a partner of Point 9 Capital in Berlin, and it talks about going from, for instance, from Series A to Series B, and still showing 3x or 2.5x of year-on-year growth in terms of ARR and MRR. So sometimes there is a lot of pressure on the founders to keep tripling their revenues year after year, to them to stay appealing for the next funding round. And to be able, again, to choose the best investors to work with them, which again, as we were discussing, will support them even more, having the right warm interest, providing the best emotional support, having the experience how to scale the companies in another stages, which in principle will increase the probabilities of the company to be successful. And that's why we want the best. So do you agree with this kind of rate, or do you think that this is flexible and it depends on the history of each company?
Yeah, I really believe the second part. I think each company, third time, it's a world in itself. Some companies, if you push too aggressive, too hard, they're not ready for these new markets, for this, you may break them. Because you're pushing them to invest all of your money into acquisition channels when what they need is new organization and new team, and they are disordered. But I'm a VC, I'm in a hurry, and you need to grow quickly for me to make a good IRR.
Yeah.
And we've seen some example of companies going bust because of that, and they need not go bust, they just need more time. Some companies it does the contrary. Some people need a constant challenge to,
exceed themselves
and stuff, and it's good for them. And it depends also on the business model and the market timing and the presence of the company as well. So I think you should take it company by company, but I know too much pressure can break the code.
Got it.
Between the company and the reality. And the reality is a number of clients are buying the products of the company, and these sales are bigger than the cost. If you're not doing that, you're not a company. You're a company wannabe. You're under equilibrium, and you need to go through break even to be a sustainable company. If you're your life playing the VC game, chances are high that you'll end up crying.
Very good point. And yeah, final question of the show, which is, if you would have the opportunity to meet Gonzalo in 2011 when he started Faraday, so what advice would you tell him?
That's a good question. Go a bit more to the gym, try to eat a bit more healthy, try to take a bit more time with your friends and family, and that's it.
Well done. That's a very good point and very well related with what you shared before about the way you support your portfolio. So Gonzalo, thank you so much for joining us today. And to our community, thank you so much for tuning in and for listening us. You know that you can join us every week and listen to the best tech leaders on what are the key lessons to scale up your business. And you can tune in via SoundCloud, Spotify, YouTube, or at scaleupvalley.com/community and just listen in the way that is more convenient to you. So thank you so much and have a great evening ahead or day if you are in the US. See you soon. Thank you.
Hello, Mike. See you. Bye.